All right. Would you like to introduce us?
Good afternoon. I'm Tommy Pate with the Journeys Group,
And I'm George Pate with the Journeys Group.
and we are here to kind of talk about the last 6 months of what the market's done and what we think, well, the last 8 months, I guess,
Yeah.
now, and what we think the next 4 months is going to be like. Interestingly enough, we have got some different opinions, and the slide we're fixing to show you, this is the slides were prepared by people much smarter than us, so we're going to agree to disagree on some things.
Yeah, it'll make for some interesting talking points. And instead of us just reading information off of a slide, you'll kind of get our opinion on a couple of things. We did one back in January on the state of the markets, kind of projecting what we thought was going to happen. And this will kind of reflect on that, how right or wrong we were about some things, and kind of what we think is going to come up. So with that being said, I think we ought to get started, shall
Let's
we?
move on.
All righty.
All right, we're going to cover, our agenda has two parts. The first half recap of 2021, we're going to talk about the summary of the conditions, the investment returns, kind of what caused those investment returns, why we've seen the double-digit increases in the markets.
Yeah, and then the second half will be what comes next. Do we expect these returns and conditions to continue? Things to be aware of, risks to monitor, and as investors, what challenges are we going to be facing in the second half of the year and going forward?
All right, let's do the first half recap. Get me out of the way. One more time. Page down, please.
Oh, sorry.
Thank you. All right, summary first half conditions. Well, the first thing, obviously, we had the ongoing reopening of the economy. COVID, we thought, had run its course, and so the economy started gradually reopening. Have above average economic growth, again, primarily COVID related. This is kind of an oxymoron because if you look at the raw data for the last 6 months of Trump and the first 6 months of Biden, the only, I don't know if it's a political thing, but the only positive aspect of it was the fact that because COVID's away, the economy is slowly starting to open. Pretty effective vaccine rollout in the United States. Now, everywhere else worldwide is uneven rollout. So even though you see on the media that people are screaming not taking the vaccine, the vast majority of people have taken the vaccine.
Which again has contributed to that reopening of the economy. And as people are getting vaccinated, they're less worried to go out and do stuff and spend money, which has kind of helped
revitalize the economy.
Yeah, kind of crank the engine of the economy again.
Pandemic threat moderated but remains. We've got the Delta variant now, and that appears to be increasing in its intensity. Easy monetary policies. Essentially, what's happened is that out of fear of causing damage to the economy, the federal government has maintained very, very easy monetary policies. The interest rates are still extremely low. They're not doing student loans yet, for example. I think they've just recently allowed people that don't pay rent to be evicted. That's starting to come back.
No, they just extended that. I
Oh,
believe.
good, excellent.
Yeah,
okay.
yeah.
So right now it's pretty easy to get money. So
they really hadn't done a whole lot of anything, and since Biden took office, there really haven't been any major changes. They've just kind of been riding the wave, for better or for worse, and we'll kind of talk a little bit more about that later. But that's kind of, again, it's easier to get money, like you said.
Yeah. Improve your labor market. Now,
I don't know that I'd fully agree with that.
I know statistically there's some truth in that, but I know all of you know, as I know, of restaurants and places that are closed because they can't get people to work. Improving labor market, I would say, yes, there's jobs available. And I know that unemployment is going down. But you'll see a graph in a minute, and it's going down, but it's not going down much. It's kind of creeping down. So I guess technically, to meet the true definition of improving, it is an improving labor market.
But it is improving very slowly, not quite as fast as we would like to see it.
Firm housing market. Now, interest rates are low. Good time to buy a house. There's a shortage of houses, so houses tend to demand a premium price right now. So it's kind of an oxymoron. If you can find a house, it's going to be expensive, but you can borrow the money at very low interest rates, 2.25%, 2.5%, somewhere in that range.
Yeah, it's a great time to buy a house because money is so cheap to borrow. and it's a great time to sell a house because it's kind of the best of both worlds. You'll see throughout the presentation that we refer to the economy right now as kind of a Goldilocks scenario. Things are not too hot, not too cold, at least for the past 8 months. You'll kind of hear us refer to it like that.
Interestingly enough, there is a greater U.S. household wealth than before the pandemic. And again, I'm not going to comment too much on that. We've got some graphs that we're going to go into in just a second.
Yeah, pretty shocking numbers. Very, very interesting to see that.
Inflation debate. The Fed say it's transitory or non-existent. I'm going to have to disagree with that. I think we're in the midst of inflation. I think it's going to get worse.
Yeah, I think that's the biggest disagreement we have with or the biggest point of contention in this presentation. We're going to talk about that, but again, we'll cover that a little bit more later.
And stable tax rates so far.
Yeah, so far.
Yeah. All right, let's look at the first half. We had exceptional returns for the stock market. Across the board, you see everything, small caps all the way to emerging markets. Did almost, the only thing that didn't do 10% was emerging markets. Everything else did.
And that's the kind of to be expected. Emerging markets are always a little bit shaky as is.
Yeah.
No, not without the presentation.
Yeah. If you look at the different sectors, with the exception of utilities, everything again blew it out. Energy was up 45%, all the way down to consumer staples, which was up 5%. So again, first half of the stock market, across the board, total returns, great.
Let me pull up the notes. I can do that. This is kind of where we're seeing inflation hit. If you look at, this is the bond market returns. Bonds have not done so well, and a lot of that's because of the concerns about inflation. If you discount the long-term Treasury bond yields, which are kind of dragging the whole average down, they range from just okay to not so okay, but fairly flat. I mean that, and again, we think inflation is kind of causing that.
And again, I'm going to disagree with the authors of this program. I don't think that's mixed returns for bonds. You've got the long-term, you've got the tips, which are up less than 2%. Other than that, every other bond other than that is in the negative.
Is either zero or down.
Yeah, so I don't really call that mixed percent. I'll call that negative for bonds.
Yep. Again, I'm sorry. No, go ahead.
Go ahead.
No, and looking at investments strictly for income, we're seeing a kind of a similar trend to stocks and sectors all across the board that, REITs have been knocking it out of the park in the first half of the year. Everything else kind of lagging behind. I would be a little bit remiss to call it a strong environment if you discount the REITs. The REITs, as you can see, are 22, 23%. Everything else is barely at 5%. So I would be a little bit remiss to call it a strong environment.
REIT stands for Real Estate Investment Trust. You probably know that. But, we've dealt with REITs for 25 years, or I have, George Chestnut. And I'm somewhat at a loss as to why REITs are so strong. REITs are real estate, and that can be anything from corporate headquarters to strip malls to apartments, condominiums. So we did some research and can't really find out why they're blowing the top off like it is. REITs are considered to be extremely long-term investments, and they're typically for what we call preferred investors, which is people that have $500,000 or more to invest. It's not for the average person like George and I are, but anyway, it is what it is. I don't have an answer for that though.
Yeah, it's hard to figure out why in the first half of 2021 they're doing so well when they're considered long-term investments. So that's kind of I guess a big question mark for us that we can't seem to nail down why that is.
And if you look across the last 12 months, by and large, the capital markets have been incredible. You see small cap is up almost 70%. The only thing that has lost money is, again, the long-term Treasury bills and some mortgage back. Now, having said that, it is our opinion that the reason why this has happened is because the government has pumped in almost $2 trillion into the stock market since the COVID pandemic. And as you know, if money goes into the market and you're buying, it drives the market up. So that's what I mean, some of this is economic growth, yes, but a lot of this is $2 trillion being dumped into the market. And you'll see on the slide in a minute some stuff that we're talking about.
Yeah, we've got a really telling graph that kind of shows money that the feds have dumped in over the last 20, 21 years. And we'll talk a little bit more about that. This is pretty amazing. If this is showing the last 50 years of the S&P 500, first half of the year returns. If you look at it, that red bar is 2021. It is in the upper quintile of the last 50 years. So it's been pretty.
So in English, it's the top 25% of the last 20 years.
Yeah, top 25% over the last 50 years. And so one of the things that we're looking at now is, okay, we've had a killer first half. So number one, why is that? And number two, what's going to happen now?
So what happens next? Will market strength continue? What are the risks we have to look for, and what are the challenges? All right, this is fascinating to me. This slide indicates the last 50 years, and every time the S&P has been in the top, has been in double digits for the first half, it has been in double digits for the second half. So based on this graph, the next 4 months, 4.5 months should be double-digit returns. And I think we'll have double-digit returns until the end of the year. I think next year is going to be a significant adjustment. I'll put you on that.
And so again, we look at this graph, and it's pretty incredible to see, but it does beg two questions again. Number one, what contributed to these high returns in the first half? What was it? What were the conditions? Was there some abnormality? What caused these fantastic returns? And number two, do we expect that to continue into the second half of the year?
Statistically, it says yes.
Statistically, yes. And so we're going to talk about what happens next. These are the things we talked about that have been the contributing factors to the fantastic growth of the first half of the year. With the exception of the last three with the red question marks, the rest of them with the yellow check marks, we kind of expect those to continue or to maintain stability.
At least through the end of the year.
At least through the end of the year, that's right. We're talking just for this year. So the pandemic threat moderates. That's a little bit iffy because nobody knows that. It's just hard to tell with the new variant coming out. There's just no telling what's going to happen. Whether or not inflation is transitory, again, we're going to talk a little bit more about that. We're of the belief that it is not transitory. Yeah, that if they don't do something to get it under control, it will not be transitory.
I emphatically disagree with that. I think inflation is rising.
Yeah, and that's one of the question points. And then the last one is stable tax rates. I can't speak for you, but I don't expect tax changes before the end of the year because that's a pretty radical change to make in the next 4 months.
Yeah, I think right now with the trying to get the economy, all the crisis that Biden is facing right now, that the last thing he's going to do is mention higher taxes. Yeah. I do think if the Democrats maintain control of the House and the Senate in 2022 and things stabilize a little bit, we'll see higher taxes then. But I don't think this is going to be a problem for the next 4 or 5 months.
Yeah. So this is the real bingo.
This is why the market's killing it.
This is the real bingo slide. Take a look at this. And what this is doing, this is showing since 2002 what the Fed has held in mortgage-backed securities. So from 2002 to 2008, they had nothing. Zero. And then in 2008, went up to.
Wait a minute, who became president in 2008?
It was Barack Obama.
Barack Obama.
The market crashed, and you can see the Fed dumped a ton of money in 2008, which helped drive the market up and keep it up in an otherwise terrible economy. And then it kind of dropped again until 2012. What happened in 2012? We had the next election, and it spiked again. And you can see instead of dropping after that, the Fed maintained that amount, a little bit of an upward trend, but not a whole lot.
Currently, they're purchasing $80 billion of treasuries and $40 billion of mortgages. And this is what keeps them, this is what's making it for the market. Now, my fear is that this is very political, obviously. If it becomes very obvious that the Republicans will take control of the House and or Senate in 2022, then I would anticipate that the Fed stop buying. because the Democrats, and this is not a political thing because the Republicans will do the same thing to the Democrats, but the Democrats will pull their support from the market and let the Republicans inherit a really nasty, bad economy. So that's why I'm thinking, I think if the Republicans win the House and or the Senate, then you're going to see the government, instead of buying 80 to 30 1.2 trillion, $120 billion, you're going to see them pull $120 billion out. And that's going to make that's going to make the market drop. Look at the very end where it skyrockets from 12/18, 2/19 to 12/18, 2020. That's how the market went up during the pandemic. It had nothing to do with the United States economy. It was the government pouring money into the stock market to keep consumer expectations satisfied. As again, this also keeps the mortgage rates extremely low and keeps a thriving housing market. Now, is anything wrong with that? Absolutely not. But when it becomes a political tool, is when it gets to be dangerous. And I think this is very much a political tool.
Yeah, and as you can see, not only did they buy a ton in 2020 to help rebound from the pandemic, they're continuing to buy. You know, this only accounts for 2020, or the end of 2020, but you can see that it is trending upwards, and there are no signs of it stopping anytime soon. Yeah. Again, which is not a bad thing, but it is a dangerous course in the long run.
And I don't know the logic behind this. I'm just interested. If you look at the Trump years, 2016 to just before the pandemic started, 2019, the Feds were pulling money out of the market. And so the years that Trump was in office, when the market was thriving, was truly an indicator of an economic growth, not a money being pumped in. Then you see 12/18, 2019, the money started to pour back in response to the COVID epidemic. Never been cheaper for homeowners to borrow. I just refinanced my house at 2.25. So the fact that they're buying mortgages and treasuries keep the interest rates down low. So if you're a homeowner or want to be a homeowner, this is a perfect time to buy. Actually, a kind of a two-edged sword though, because the housing price has never been higher either. And so interestingly enough, you may be able to get a lower interest rate, but you may not be able to qualify for the house that you want because a $200,000 house may be $350,000 nowadays.
And so on the flip side, cheaper to borrow, also good for if you're a homeowner looking to sell, because again, as we're seeing, what the Fed is doing keeps mortgage rates low, but it drives up housing prices. So again, kind of I guess both sides are winning here in the sense that cheap to borrow the money to buy a house, but if you're looking to sell a house, you can make a killing right
now. And the only loser here is people trying to buy their first houses.
Yep. Like me.
Yeah, like George.
Yeah. This is the big slide that when we were preparing for this, he and I both raised an eyebrow. I don't totally disagree with it. I think it can be a little bit misleading. So if you take a look here, what this is measuring is personal consumption expenditures. So what people are spending. So throughout the Trump administration, inflation was, close to zero. Over those 4 years, if not a little bit negative here and there. Now, looking at 2019 into 2020, when the pandemic hit, inflation hit an all-time low, or it spiked downwards. Now, that was because people were staying home, not going anywhere, not spending money because they were afraid of the pandemic. Get that, totally fine. And then after a little while, people realized, okay, maybe it's okay to start going back out and doing things again. People went crazy spending money, and that's when you see that really sharp spike up. And so to say that inflation appears to be calming down, I agree with that to a certain extent. It's still around, and it's still on the rise, but I don't think it's quite as volatile as it was last year. I mean, it's trending upwards, so it's not volatile, but to say that it's transitory, I think is wrong.
Yeah, I vehemently disagree. I think if you see that massive spike, and of course, as George said, that's because people coming out after COVID and all that. But if you look down, there are two fairly significant upward peaks after July of 2020. I think inflation's here. I think that we're going to see some interest rates being raised. I thought it would be raised in May, and they didn't. They've already announced they're not going to raise them in September. But again, if we have a turn in leadership, turn in power, I think you'll see higher interest rates in 2022. And I think we need them, quite frankly, because I think
Yeah.
you need to get stay ahead of inflation, not wait till it's beating you upside the head. George doesn't remember this because he wasn't alive, but I remember when I was in college, inflation was 18% under Jimmy Carter. And we just can't stand that right
Yeah, interestingly enough, this is going to sound kind of backwards. The less volatile inflation is actually good for the markets. The Feds have convinced the markets that inflation is transitory and much less volatile, and it is less volatile. It's going up, but it's not rapidly changing directions. So it's good for the market because people think they were thinking inflation was low, it's not as volatile. So, and the market was agreeing with that. So it encourages people to buy and to spend money and things like that. But in the long run, you can see it's biting us.
Interest rates have remained low since the Feds started quantitative easing 13 years ago. We have a lot of phone calls here from people that are trying to find a short-term investment because CDs are paying nothing.
Like less than 1%.
Yeah, saving accounts are paying nothing. And unfortunately, there
nothing.
is no short-term investment that's worth anything.
Mm-hmm.
There are some guaranteed contracts that are 5 years that pay 2.5%. Well, I wouldn't do that. And so this is indicative that the bond market doesn't really worry about inflation because, again, if they were worried about inflation, then they would start creeping back up. Well, if the Feds raise the interest rates like we think they will do in 2022, then the bond market will go up with it as well. But right now, bonds are, I don't want to say they're not a player, but they're pretty much not a player.
It's very difficult to find a short-term fixed investment
that's worth buying.
Yeah, that'll give you any kind of yield. So you're having to look elsewhere for any kind of yield or growth. Again, looking at from 2016 through 2020, the at-home economy, I really like that term. Looking at Amazon, things like that, kind of a slow uptick. 2016, 2017, there was a spike in 2018, and I was not able to find what that was about. And then when 2020 hit, there was a huge spike.
Well, actually, the huge spike is 2019.
2019. Yeah. I'm sorry.
And people buy from home because of COVID.
Yeah, people don't want to go out. They don't want to go to the grocery store, so they're just ordering everything online, and it's convenient. And we're not anticipating seeing that reverse anytime soon because Amazon is such a. I'm going to use Amazon as the example. Amazon is such an integral part of our society now. I mean, you can order just about anything on Amazon, and it's there the next day. So not only do we not think it's going to reverse, I anticipate to see it going up. Market implications, great time for IT, communications, things like that. Commerce these sectors are killing it right now because of things like Amazon.
All right, unemployment. I
have a hard time with this one.
Yeah, I disagree with this as well. If you look at the slide, it says the Goldilocks environment, wages, inflation, not too hot, not too cold. Unfortunately, I'm going to say something that's very probably not kind. Unfortunately, with the government handout programs that they have done, the unemployment, that kind of thing, if you're a low-skilled worker, you can make more money by not working. And that's what we're seeing. We're seeing traditionally the lower-paying jobs, waitresses and laborers, that kind of thing, are empty. Because, I mean, quite frankly, if you're going to pay me $800 a week to stay home,
I'm going to stay home.
Or I can make $500 a week digging a hole, I'm going to stay home. And so that's why we're seeing the restaurants, the construction, that kind of thing is not doing well because they can't find people to work. And I put that completely at the feet of the federal government. Any human being that you pay to stay home is going to stay home. So, unemployment's better, but until the federal government pulls their unemployment benefits and instead of makes them a luxury, the unemployment's not going to get any better. The jobs are there, but the desire to work is not.
Yeah, and as you can see, it spiked during the peak of COVID. Obviously, a lot of people were laid off, and then had a pretty steady downturn until, I guess, the end of 2020. and it looks like it's kind of stable. It's kind of stabilized out, and unemployment's hanging out around 6%. And quite frankly, I don't see that changing anytime soon until, like we said, until these unemployment benefits stop going out or there get some restrictions on it. I just don't foresee that. I think we've kind of hit the limit of how much improvement we're going to get until something changes.
Yeah.
So there is that. This was really interesting and kind of makes sense. People people have a lot more cash lying around now because, again, because of the pandemic, people aren't able to go out and spend money like they used to, so they're stockpiling money, which is
That doesn't appear to be happening to me.
me neither. But
Yeah.
we've also just been going out spending money. Again, what does this mean for the markets? It's a good sign because people have money to put into the market, which is contributing to the strength of the market.
And really, that's more a sign of the strength of the United States consumer. If this becomes a pandemic again, will this trend continue? Probably.
Probably.
But as you can see, again, I agree, disagree. As you can see, the end of the graph, those numbers are coming back down. They're heading back down fairly precipitously at what the 2016, 2017 rates were. So I don't see this as a
new standard.
This to me is very transitory.
Yeah, I don't think
Yeah,
this is a new standard.
Yeah, I don't think this is something I go, oh, I feel good about this. I think it's very transitory. All right, the net worth though has gone up considerably now for two reasons, and this is primarily talking about wealth. The household wealth in the United States went up $10 trillion. Now, if you consider that the entire United States economy is 22 trillion, household wealth going up 10 trillion is huge. Now, what caused that? Well, your $500,000 house is now worth $750,000. Or because the market is doing so well, people are doing a lot of the margins and a lot of the more dangerous investing. Now, what that means is, if the market does go down in 2022, like we think, those people that are on margins and that are stretching all the way out are going to get hit hard. So if I'm right, and I guess like everybody else,
I think we are.
If we're right, then I think this trend will sharply reverse in 2022.
And we've got a slide on that. We'll kind of talk a little bit more about that in a few minutes. Yeah. Again, you can kind of see where this wealth has come from. So general assets, things like your 401k, stuff like that, net worth, financial assets, and mutual funds, corporate stocks, things like that. So there's a lot of things that we kind of discussed that have helped contribute to the asset growth as well as the market growth.
The highest level, as we've talked before, has been cash, and I think that's because people haven't been out spending any money. I wish I could say that it was the United States consumer was being clever, but I don't think that. I think there just haven't been opportunities to spend money. Most people haven't been on a plane or had a trip in a year.
Yeah, and if you take a look at we see cash is up huge, 178%. If you look at the next one, corporate stocks, corporate equities, and mutual funds are up 67%. The S&P 500 hit 34 new all-time highs in the first half of 2021. And again, that's where you're seeing these increases of those mutual funds. One thing to take a look at though is that third bar. Those are
loans.
Those are liabilities rather than assets. Those are liabilities, up 48%. That's not insignificant. That's a pretty fair increase, and we'll talk about that more.
1 second.
Oh yeah, go ahead.
One thing I want to point out too is that you see the cash has gone up 178%. Prior to this explosion, the cash levels that most people had weren't that high. So if the average household had $10,000, and I'm just making a number up, had $10,000 in cash, then 178% would mean they now have $17,000 in cash. So yes, the percentage increase is impressive, but I bet for the vast majority of Americans, the actual cash increase isn't that impressive. Because again, if you have $5,000 and it grows 178%, okay, good, but it's not that much. And that just triggered a thought on me. I bet that
Percentage looks
the percentage
impressive.
is impressive, but the real life is not.
The actual number probably is not nearly as impressive as we think. So, again, going back to those, talking about these margin accounts and the more risky investments. So, people are being more risky right now because the market is doing so well. So, bigger profits. This is a really important slide. Also means bigger losses. When the market corrects, and it will correct at some point, it may not be next year, it may not be the year after that, but at some point the market will correct itself. That's going to be big. These people with the huge profits on these really risky investments are going to have bigger losses, which is going to force them to sell. When they're forced to sell, that causes volatility and more selling. So we've got a negative feedback loop once this happens. And at some point it will happen. So something to be aware of.
Yeah, I enjoy playing blackjack. I enjoy playing poker. That's gambling. I do not do margins at all. Not for me, not for clients, period. Because when that market goes down and you get a call from your broker that says you got to put $500,000 cash into this account by tomorrow, a lot of people won't have it. And as George said, that's when they liquidate entire portfolios to cover one bad call. So if the market, again, if we're right and we have a hit in 2022, there's going to be some people that lose a lot of wealth.
GameStop, probably one of my favorite stories of the year. I'm sure y'all are familiar with what happened. I'll very quickly summarize. We had a group of people on the internet that decided GameStop was the stock that they really liked, and they did to Wall Street what Wall Street does to normal people like us every single day. They bought every share they could. They drove the price way up, forced the big hedge funds to sell at a massive loss, and you got people my age that became millionaires overnight. Now, the fundamentals of GameStop, the dollars and cents, the numbers of GameStop haven't changed. GameStop's not a great company anymore. But what this is showing is that if a bunch of normal people get together, they can cause these huge volatility spikes in the market.
Well, because of the ability to trade, anybody can trade online, then normal retail investors can cause a huge spike, a huge price distortion. I mean, massive, like at GameStop. Now, you got to get enough people to play that game. But that has become a very real factor that we have to consider. That some people may get together and decide that Joe's Fish Market needs to skyrocket, and they find 1,000 people to push Joe's Fish Market stock, and it goes up. So that's a new player in our industry that's never been there before. But clearly, it's happened one time. It can happen again. Yeah, it probably will.
Yeah, but again, keep in mind that, I mean, I had friends that asked me about this. Should I buy GameStop? No, because by the time you found out about it, this is temporary. It lasted, I think, 3 days, and then by the time it was done, GameStop was lower than it had been before all this started. So it's temporary.
And by the way, those of us that do this professionally, I thought that was hysterical.
Oh, God,
because
yes.
A bunch of retail kids did to Wall Street what Wall Street does to us. They played the game masterfully, and a lot of funds that make money off of our inability to buy and sell lost a bunch of money, and I applaud them. I think they did a great job with it.
I think the final number, the hedge funds lost something in the neighborhood of $50 billion in 24 hours, so much so that they went to the SEC and said, this is illegal, you've got to stop this. And the SEC said, no, they did, everything they did was perfectly legal.
Yep,
so this has probably been one of my favorite instances of the market this year. But again, it just goes to show you the power of retail, and that retail investors have when they band together. So,
all right, what happens next? Best case scenario, we'll have above average economic growth. Easy monetary policies will continue. The pandemic threat fades, and we have a strong U.S. consumer.
Kind of everything just continues the way that it has been.
I don't believe any of that's going to happen.
No, quite frankly,
no. Investor implications. If this happens, best case scenario continues to be a good environment for stocks. Growth sectors and cyclicals continue to grow, and income continues to go up with real estate. I don't see high yielding bonds anytime soon if they don't raise interest rates.
Not until interest rates are affected. I just don't think bonds are going to change anything.
Yeah.
Things to monitor. Now, obviously, resurgence of the virus for your health reasons and for economic reasons. Overheating economy, that's on its way. If they don't do something to stop this, the economy will burn itself out, and we're going to be in big trouble then. It'll be much worse than if they just if they tap the brakes rather than having to slam on brakes. Higher taxes. Biden mentioned that before he got into office. Hasn't really mentioned it since, but he said too much going on to bring that up. He wouldn't dare bring that up with everything going on.
And that global minimum corporate tax is going to be a booger because this is a lot of countries banding together. You know, currently, we saw under the Obama administration, he jacked the corporate taxes up, and so a lot of corporations left the country, went somewhere where the tax environment was more favorable. So the global economy has said, we're going to stop that. We're going to have a minimum corporate tax worldwide. Now, that means that the corporations can't deduct those taxes. But anybody that thinks they're going to pay them is foolish. What that means is they're going to raise their prices to the consumers to offset this increased corporate tax. What does raising prices do? That would be inflation. And so I don't understand why governments continue, this is worldwide, why governments think that they can squeeze money out of corporations and it not trickle down to the consumer. Because I promise you, if this global minimum corporate tax is passed, and I think it's probably going to pass, then I think you're going to see price increases worldwide. And the consumer is going to be the one that ultimately pays for that.
All right, so let's kind of wrap it up. Right now, we're in kind of a Goldilocks period, not too hot, not too cold. I think we're kind of coming to the end of that. I think we're starting to get too hot. So right now, things are pretty calm. Take advantage of that time, prepare for the storm. If you're working with us, we've already prepared for that storm. Everything that all of our plans take into account things like this. Make sure your portfolios have the appropriate risk levels for your stage in life. And I cannot stress this enough. At some point, a downturn is going to happen, whether it's next year, whether it's 20 years from now. Make sure you're aware of that. Make sure you know how that will affect your investment. And this last point, I cannot stress enough. Do not overextend your reach to chase returns. If you're 3 years away from retirement, you are not shooting for a 25% return. If you do, there's a good chance you'll strike out, especially in the environment we're in right now.
And I don't care how old you are, don't ever chase returns. Chasing returns inevitably ends up in the red.
Yep. So challenges, same things as they were pre-pandemic. Again, working with us, the challenges are always going to be the same no matter what's going on. Participation and protection, and where do you find the best yield? Now we have legalese,
the legal disclosure,
more legalese, and then our disclosure.
And do we have questions?
Yeah. We'll open the floor to questions now. If you want to just type them in the chat box, if you've got any questions, feel free to fire away. We'll sit here and answer for as long as y'all have questions. And nobody's got any questions, we will let you find people enjoy your evening. As a reminder, this webinar is being recorded, so it'll be uploaded onto YouTube. We'll probably share it to the Facebook page as well. So if you want to go back and listen to it again, watch it, take notes, be able to pause and start things like that, that's where it'll be. So we'll open the floor to questions in the chat box.
And I hope that, we've been kind of have had a negative viewpoint. And understand that in an economy, part of a thriving economy is bad times. There's no, every economy has inflation, every economy has economic downturn. That's all part of it. So don't misread the fact that we're thinking it's going to get a little tough here in 2022 as, we're in trouble. Not that at all. We just wanted to make you aware of it. As George said, when we design portfolios and design plans, we take into account there could be some rough waters coming. So
not that there could be, that there will be.
Yeah. So this is normal economy. Nothing dramatic about it. But I don't see any questions. I think we'll let these people go.
Let me check the Q&A real quick. No, I'm not seeing any questions. So we're gonna let you fine folks get back to your evening. Thank y'all so much for joining us tonight and taking time out of your Tuesday evening to join us. We'll be doing this and the state of the markets will be an annual thing for sure, especially with everything that's been going on. So thank y'all again, and we look forward to seeing you next time.
you have any questions, give us a holler.
Have a good night, guys.